Hello, and welcome back to Reflections on Investing with the Cornell Capital Group. And today we're going to dive deep into one of the most important valuation metrics in investing, the CAPE ratio. You might have heard about this, and we've talked about it before in some previous reflections, but today we're going to go a little further into its history and what it's telling us now and what the future might hold for stock returns. So what is the CAPE? The CAPE, or the cyclically adjusted price to earnings ratio, it was developed by professors John Campbell and Robert Shiller back in 1988. It's basically a PE ratio for the S&P 500. But unlike a regular PE ratio that just uses the 1 year of earnings, the CAPE takes the average of the past 10 years of inflation-adjusted earnings to kind of smooth out business cycles. And it's also called the Shiller PE, again named after Robert Shiller, who popularized it during the dot-com bubble when he correctly predicted that the market was overvalued. And that's the way, it's kind of the way to look at it. Historically, a high CAPE ratio suggests that stock prices are elevated relative to long-term earnings, indicating that the market may be overvalued and future returns could be lower. And on the other side, a low CAPE ratio points to stock prices being low relative to earnings, signaling undervaluation and possibility for higher future returns. But you need something to compare it to. And traditionally, comparing the current CAPE level to its historical averages, investors can gauge whether equities are expensive or cheap, and helping them inform their investment decisions. And actually, the CAPE is a fairly good predictor of longer terms, talking about 10 years or more, returns. But this is important. CAPE is not a reliable tool for short-term timing. Stock prices can, and they often do, remain above or below fair value for years before reverting closer to averages. So in the short run, everything from economic surprises, geopolitics, and investor sentiment, it can overwhelm fundamentals. And that means market moves over the next year or two, they're largely unpredictable, even if valuations seem extremely stretched or cheap. So while CAPE can give us a valuable signal about what to expect over the next decade or so, they shouldn't be used to decide when to jump in and out of the market over weeks or months. So we look at them as foundational tools for setting long-term expectations, not market timing. So now let's look at the CAPE. And since, you can see in the chart here, since 1900, the CAPE has averaged around 17.74. So now if the CAPE reverted to its full historical mean, back to 17.74, stock prices would need to fall about 53%. So yeah, that's a bit scary. But should we be using the long-term average since 1900 to compare with? Or have things changed? Solid argument could be made that there have been some structural shifts, and this is something that we've written quite about, and I'll link our paper to it. And you can kind of notice that there looks to be a prominent break in the data around 1990. And so let's look at this chart. So from 1900 to 1989, CAPE averaged just 14. But since 1990, it's been above that pre-1989 mean virtually all the time. And the post-1989, from 1989 to today, it's been about 27. So nearly double the earlier period. So it definitely does seem possible that post-1989, there could have been structural changes and legitimate reasons for the fair CAPE mean to be higher than the long-term historical average. So now we're going to look at what a current fair value for the CAPE could be from a few different ways. So we'll start here with a structural fair value approach. And there are several qualitative reasons that the normal CAPE could be higher than it used to be. And that's number one, lower interest rates. So lower interest rates means lower discount rates, and that increases the present value of future earnings. And so we can add, say, 3 to 5 points to our fair CAPE from the long-term average. And number two is the tech dominance in intangibles. And tech and intangible intensive companies, which are now the biggest companies in the world and in the US, they trade at premium valuations. And then the proper capitalization of those intangibles in accounting would probably boost earnings and reduce CAPE by around 12%. So this is going to add another 2 to 3 points to our long-term average. And then finally, was some accounting changes. In 2001, changed ending goodwill amortization and boosted reported earnings. So we're going to add about 4 points to our normal CAPE. So all in all, it's going to add about 10 points from our long-term average of 17.74. So that, using this method, that's going to give our fair value CAPE to be around 27.74. So now let's look at another approach. So another approach is just to use a long-term trend line from the beginning. And if we draw a trend line from 1900 to 2025, capturing 125 years of market history, that trend line shows CAPE should be around 25.8. And this trend captures the gradual evolution of the economy. It accounts for industrialization, the rise of modern finance, and all the structural changes we've discussed. And then lastly, we could just use simply the average of the most recent period starting in 1990. So from 1990 to 2025. And that is 26.67, which we showed before. But the amount of data there is limited, so you might take it with a little bit of a grain of salt. But here's where it gets interesting. So now we have 3 independent methods: structural fair value adjustments, the trend line, and the modern era average. And they all point to roughly the same number, mid-upper 20s. So let's say 27. We'll use 27. But this convergence does give us some more confidence in the analysis. So again, if the current CAPE, which is 37.8, if that reverted back to our new fair mean of 27, it would entail a 29% decline in the S&P 500. So it's not nearly as dramatic as the 53% decline if it was going back all the way to the long-term historical average, but it does still indicate an overvalued market and thus muted stock market returns over the next decade. And again, just to reiterate, this is over the next decade. This is not saying anything that could happen in a year, 2, or even 3. But for stocks to keep climbing in the long term from here, we need to see sustained earnings growth, like far above norms, and then further declines in interest rates or new structural shifts that can justify even higher valuations, or a major productivity boom from AI or other technology breakthroughs that exceed expectations. But expectations for AI are already quite high. So the bottom line is that the 3 independent measures, the trend line, the post-1989 average, and the structural adjustments, all define fair value CAPE in roughly the same range. And with it now standing at 37.8, we are moderately overvalued and likely facing lower than average returns over the next decade. So thanks. This has been Reflections on Investing with the Cornell Capital Group. I hope you enjoyed it, and we'll see you next time.